Hey, welcome everybody.
All right.
Today, we're recording it on Saturday today. We
Yep,
had
yep.
a little Thanksgiving get together. Jerry came over to the house and smoked some
Good
cigars.
times. Yeah, little
It's
fire
nice.
fire pit, cigars. Moving a little slow today from
From all
might
of
have
it.
ate a little bit too much and
Yeah, I gobbled till I wobbled. That's for sure.
yep, good stuff. The market tends to do the same kind of thing. Like
Yeah.
definitely tends to go up Thanksgiving week
Mm-hmm.
and but low volume because there's not
Not
too
a
many people
lot of
out
trading
trading
going
and,
on.
yeah, everybody's Black Friday and Cyber Monday and that's all the
Everybody's shopping.
yeah. So we
Yeah.
shall see how that all ends up. It's
My
going to
kids
be
tried to get me to go out shopping, and I was like, that's not
like
happening.
not virtually, like
They
actually.
went to Tyson's Mall.
Oh no.
Yeah, it's insanity.
No way.
Nope.
But we shall see.
I'd rather be burned at the stake.
Ugh. All right, TSP Weekly Newsletter, 1 December 2024. So what happened this week? Like we said, not a super busy week. Wednesday, actually, a lot of economic data came out, so we'll look at a little bit of that. The smart money is not chasing this rally. We'll talk through that. Yes, the market's going higher. Smart money is not trying to get out at the top. They get out before the top. So we'll take a look at that a little bit. And a lot of people have this idea of buy low, sell high. It sounds great. A lot easier said than done. But you can do it. You can do it in TSP too. So we're just going to show how do you know when something is relatively low versus relatively high. Hint, it's the relative strength index and the TSP charts. So Monday we get Chicago Fed National Activity Index, basically how a broad index of how the economy is doing. It decreased to negative 0.4 in October. It was the lowest number since January. And yet the S&P 500 was up a third on Monday. So this is what it looks like. The National Activity Index decreases to negative 0.4 in October, the lowest in 9 months, and much worse than market forecasts. So index is suggesting economic growth decreases again, which you can obviously see in the trend. So it's no surprise. Everybody knows the economy is slowing. Can it pick back up and we just keep on moving? It's possible. Does the stock market end up rolling over because the economy is rolling over? That's possible too. And that tends to be what the smart money looks at. You got new home sales for October. It doesn't look like much on the numbers. Went from 0.61 million versus 0.74 million in September, right? And 0.71 million was the forecast. So it's significantly lower than the forecast. S&P was up 0.57%. But this is what new home sales looks like for October. Pretty unbelievable. Plummets 17.3% from the previous month. Seasonally adjusted, whatever. It was the sharpest decline since 2013 to the lowest level since 2022 and way below expectations at 730,000 annualized sales. So no one bought houses last month. Median price, new houses was 437, 11,000 above. It's pretty crazy. We get 9.5 months of supply at the current rate.
That's just crazy. Like that's across the whole U.S. $400,000. I mean, where we live, we kind of like we get used to that because the numbers here are just ridiculous.
Yeah.
I mean, our home is on paper over doubled in the last 5 years. That's ridiculous. But for the rest of the country.
Well, the scary thing is the rest of the country is kind of like that too because so median price of new houses was 437. That's the median. The average price was 545. I mean, even at like 437 in low cost of living areas, they probably certainly maybe not double, but they went up in value too. So imagine you're in the middle of Arkansas or whatever, paying 437 for the median.
I actually have been looking out there to kind of get perspective. Because I lived in Arkansas for 10 years. Part of the time I was in the Army and then went to college there. And anyway, I'm not from there though. Love the Razorbacks, but I'm not from there. But anyway, I actually checked this past week because I was looking at housing numbers and I was like, And I couldn't believe some of the houses that were like $300,000.
That's a lot of money
I'm
there.
not talking about in Little Rock.
Yeah.
I'm talking about like in towns
Yeah.
way outside that you wouldn't even have ever heard of. And I was like, how in the world is someone there buying a $300,000 house?
Yeah.
You know? I mean, the reason why I think it's such a big deal is, you know, this idea, especially in the government, and sometimes it works out this way in the military, you know, you kind of work your way. A lot of times you'll get promoted your way into like high cost of living areas,
Yeah.
Boston, DC,
Yep.
New York, whatever, because you got to go there to get promoted.
Yep.
A lot of times. I don't know if it's like that for the rest of the government, but in law enforcement and intel and things, there's certain,
Yeah.
like that just happens, right? But the idea is that, you know, I'll get out on my high three, I'll get as much money as I can for retirement, and I'll go to a low cost of living area, sell my house, make a good, you know, that's starting to disappear because there isn't any low cost area,
Yeah.
you know, unless you want to go completely off the map. And a lot of times you don't want to do that. You know, you don't want to go somewhere where there's absolutely nothing.
Right.
Some folks do, you know, they want to disappear, but not usually, you know. Anyway, it's just troubling that it has to calm down, because if you can't sell your house, if you sell your house and now you can only afford a smaller house that costs the same.
Yeah. Why would you sell your house, right?
Right.
I mean,
That's kind of where we're at around here. You sell your house, you're going to get a smaller house for more money.
For more money, yeah. Yeah.
Than you paid for the house originally. Yeah.
And the rates are higher, and you know that's why you got, you know, basically no housing movement last month, because for all those reasons. And obviously, if you're a new home buyer, you're screwed. I mean, if you're like in your 20s trying to buy a house, it's really hard.
Yeah. Anybody out there that's doing that, tell us how you are, because I don't know how.
Well, Jenna's boyfriend did. Just bought a new house. She was my daughter. Her boyfriend bought a house. He took over a biomedical engineering company. Like, it's not a huge company, but I mean, he's now the president of this company after just getting out of college, and super smart kid.
Family company, right?
Yeah.
Yeah.
But that's obviously a huge one-off, and that's in central Pennsylvania. It's not, you know.
That doesn't happen very often.
No.
I don't know how regular, quote unquote. I mean, I'm guessing that many of them are just living at home with their parents.
Yeah.
Even married couples in their 20s.
For sure.
Don't get any ideas,
kids. All right. So where am I at? Yeah. So along with that, so mortgage rates on Wednesday, we get mortgage rates basically stayed the same, went down, you know, from 6.9 to 6.86%. So it came down a little bit, but new mortgage applications, which is weird, jumps to 6.3% from 1.7 last week. Which that's the chart of that. Like so the trend in new mortgage applications is actually going up. I don't know if it's people thinking that, okay, the Fed's lowering rates, but rates aren't coming down, so maybe I should get in now. Like, I don't know how you're getting in. And so, you know, some of this is leading and lagging. So on the one hand, we showed that nobody's buying houses in October, but this is showing that the trend of new mortgage applications is going up. So
yeah, that's what I was going to say. I mean, maybe this is just a leading indicator that's going to crank up a little after the first of the year, because usually it takes a little time to get your mortgage,
right,
and then actually making the purchase. And
yeah, I mean that's exactly what this is. You know, you will see an uptick, and obviously when all these mortgages get executed, there will be an uptick. And what else do we have? Jobless claims stay the same at 213,000, so that's pretty good. No new people basically on the laid-off rolls. Core PCE is one of the big Fed inflation numbers, and it stayed the same at 0.3, the same as it was last month. But personal income jumped 0.6 versus 0.3 last month. So people are making more money, which is good, and maybe that's why there are more mortgage applications. I mean, all the stuff relates to each other. Thanksgiving, markets closed, no financial reporting on Thursday, and nothing really significant on Friday, but the market was up a little over 0.5% on Friday. So smart money. One of the smartest monies we talk about, of course, is Warren Buffett, and we've talked about this for a while. He's loading up on cash. This was from the source is Bloomberg, but it's from this YouTube. Can't remember the guy's channel, but I got a couple of slides from him on that. But that's the YouTube channel if you wanted to go to the link. But basically what it's kind of showing is the percent of cash that Berkshire Hathaway, Warren Buffett's company, has, and it kind of goes along with the cycles. So as his cash level increases, he's raising cash in anticipation, not necessarily of a market crash, but for earnings to come back to a level that makes the value of the company better in terms of a risk reward to have it be more profitable going forward. And what tends to happen, like he built up a whole bunch of cash right before the dot-com crash to be able to buy things when the crash happens. And the same thing going into the financial crisis, right? And so the point right now is this is his highest level of cash, at least since 1990. So it's not necessarily that a lot of this gets spun in the financial media as, Warren Buffett's going to cash and so the market's going to crash. That's not necessarily the case. It can just be earnings catch up to price. So if earnings started moving higher and price didn't go higher, which would be very weird in this environment, but if that happened, then the valuations would start to make sense and he might find things that he was willing to buy. It's just that right now, the valuations are really, really high.
Mm-hmm. And you have to have cash on hand when the time comes. You can't you can't liquidate, like in his situation,
right,
that much. So I personally think it's a heck of a sign, because when a person like that, when in a group like that, it's not just him, right, are making these sort of, I would say that's a leading indicator that somebody thinks that things are going to be really cheap.
They're definitely not cheap now.
Right.
And
yeah. So what does that mean? For them to get cheap means prices have to fall drastically,
or earnings go up and prices don't move. I mean, it's a ratio. Yeah. So I'm trying not to get too bearish, basically.
Yeah, no.
Right. You can get hung up on this idea that the market's going to crash, and that's why.
But I'm leaning there, and it's just as a value investor. I'm not saying I am. Yeah. They are for sure. That's what they're searching for, is that value. And if you could pull out of the market heavily before the Great Depression, the people that did,
pretty well.
That did. And I'm not saying we're going to have another Great Depression. I'm not that bearish, but something has to happen. I mean, I don't know when, but something has to happen.
Yeah.
And I think Warren Buffett thinks so too.
Yeah, I would agree. And so how does he know? Basically, this is it's called the Buffett Indicator, the Buffett ratio. It's very simple. All he does is take the total value of the stock market and divide it by gross domestic product. And that's the way that he figures out the big picture value of things. So if the stock market is $60 trillion divided by the GDP is $29 trillion, it's 208% is the indicator. And so the ratio fluctuates over time. Since the value of the stock market can be volatile, obviously, right? The numerator can change a lot. GDP doesn't change as quick. GDP tends to grow more predictably, right? The current ratio of 208% is 66%, about 2.2 standard deviations above the historical trend line, right? So it suggests that the stock market is strongly overvalued relative to GDP. So that's the metric that he uses to figure out whether or not the market is really overvalued. And the higher this number gets, the more he goes into cash, because it's a value. He's not necessarily calling for a top in the market. If GDP picked way up, then this ratio would come down, and then he'd start buying again. So you don't have to have a market crash. You can grow your way out of these problems. It's just really hard to do. And then this was another kind of similar indicator we looked at like last week, the week before. It's the Shiller PE ratio. It's also called the CAPE ratio, but it's the price divided by the average earnings over 10 years that are inflation adjusted. So you can kind of see this goes back to the 1800s, and when it's saying that price divided by earnings. So when price gets really high relative to earnings, there's only so high it can go. It's getting way outside the mean, and the mean is something like 15, and we haven't seen 15 since the bottom in 2009. So this is a pretty good chart because it kind of shows this trend right, is similar to kind of these trends. It's not like a blow off top, right? Like we had this was the top in 29. This is the top in the tech bubble. So what we have right now is more kind of like these. This decline right here was the bear market in 2022. And that didn't even take us outside of the trend. So if and when this thing rolls over, if we break that trend line, I mean, just coming down that much is similar to the 22 bear market. If we get below this trend line and keep going, things get much worse in a hurry. Okay, and the big point of all this, as far as if you're a TSP investor, is the impact of losses. So we always say, well, the first rule of investing, basically, they say, is also the second rule. I mean, not losing money is the most important thing. So avoiding losses is really, it's critical, because we'll get to that in a second. These are some of those, so memorable declines. I don't know how memorable these are for a lot of people, but 1929 to 1932, the Dow Jones Industrial Average, because the S&P wasn't around then, the Dow was down 89%. And you're like, well, that's the Great Depression, doesn't really have anything to do with these days. All right, 73 to 74, the S&P is down 45%, 48%, whatever that says. The dot-com crash, the S&P is down 50%. The NASDAQ is down 78%. So that's something that people kind of overlook, because even though most of us have a memory back to the 2000 top, and people are like, well, the market was down 50%, which is bad. The S&P was down 50%. The NASDAQ was down almost 80%. And so when does the next one happen? Who knows? But this is the important thing for us. If you lose 50%, you have to make 100% of what you have left to get back to even. If you're down here at 80% of loss, like the NASDAQ was from 2000 to 2002, you have to make 400% on your money just to get back to even. And so
that's why when people make fun of the G fund, they don't know what they're talking about.
Yeah. And the most interesting thing I thought from this slide, to be honest, is this. So since 1901, the stock market has spent 76% of the time declining in value or recovering from loss. So this is kind of tricky to get your mind around, but if you look at it on a chart and you look at it that way, since 1901, if you looked at it on a chart back to there, you would see this. Obviously, it goes up and to the right? Stock market goes up. But 76% of the time, it was either going down or it was recovering to that prior high. So, yeah, if you were in the G fund during those big declines, even if you just rode it out and got back in at the new high, you'd be even, but your Sharpe ratio would be great, right? Because your risk-adjusted performance would be great. But if you were able to get in somewhere when the trend turned back up, you're way, way ahead.
Yeah, and that's most of the time what we spend most of our time kind of focused on. If you are new here, or even if you're not, and we haven't talked about it in a while. I mean, a lot of the things that we talk about are about avoiding catastrophic loss. Yeah. And catastrophic can mean different things to different people. 25% to me is catastrophic enough in my retirement account, right? How much less 50 or 80, like Jerry's talking about. Like, I don't want to lose a fourth of my retirement account.
No,
I don't know anybody that does, and I don't want it to take 50% for me to get back to where it was. So that's why for us, the G fund is such a safe bet in certain situations. Now, because you take that if you take that position, you're going to get whipsawed. It's going to happen. But you're not going to take these huge drawdowns. And frankly, I don't, forget about people that are getting ready to retire or in retirement. I mean, I wouldn't want to take that when I was 30, because it eats away at your snowball.
Yep.
Your snowball, as it gets bigger, the compounding goes faster. Everybody kind of knows that concept. So if you're 30 years old, 35 years old, and you get hit with one of these things, and it takes you, several years to recover, not only are you trying to get back, but your snowball got smaller.
That's the problem. Is the compounding.
Yeah. It's compounding problems is what it is.
And if you're retired, like, you have to look at it in a completely different way.
Yeah, you're not coming back from it.
You're not coming back.
Because you're not contributing.
You're not contributing. You're probably withdrawing. You really have to look at this stuff in a different way. I certainly do now that I'm retired. It's just, it is what it is. All right, buy low, sell high. So everybody, obviously this is probably the biggest meme on Wall Street, right? Everybody wants to buy low and sell high. So you can do it using this thing called relative strength index, which we show on the charts all the time. But this is kind of the definition of it, right? It's a momentum oscillator. So Wells Wilder created it. It measures the speed and change of price movement. So RSI moves up and down. It oscillates along a zero line between 0 and 100. When RSI is above 70, it generally indicates overbought conditions, meaning you could say it's overvalued. Okay. When RSI is below 30, it indicates oversold, or a place where Warren Buffett or somebody like that might come in and buy it because it's oversold. It can also generate trading signals via divergences, which we talk about all the time, between price and relative strength. Failure swings, centerline crossovers, we talk about a lot of that stuff. But so I got a couple of examples of what I mean. This is the 70 line, right? This is the 30 line. So anywhere in there, it generally oscillates along the 0 line, right? But between, this is the 50 line. So this is 70, this is 40. It's generally oscillating in between there. When it gets above 70, it's considered overbought. When it gets below 30, it's considered oversold. So the challenge with that is, just because something gets overbought, like right here, right? We're looking at this is Bitcoin. So if you sell something when it gets overbought, it can stay overbought for a long time, and price can go way higher. So one of the best ways to use this, I think, is to follow the orange line, which is the trend line of the relative strength. When this orange line gets above 70, things are getting really overbought. And then you watch it, and when you start having a divergence, when relative strength starts putting in lower highs and price is putting in higher highs, the end is near. And it's the same thing on the bottoms. When, even though price here is still declining, right, getting lower lows, the relative strength is starting to get better. So it's telling you that this is the bottom. It's getting ready to turn. And once it pokes up, and again, that orange line at the bottom is just as good as it is at the top. The moving average line of the relative strength. So when we had this big pop right there, the odds of it rolling over at that point are slim. And so on a short-term basis, right, once we got overbought on Bitcoin back here, and it's so close to that 100,000 level, for it to roll over and consolidate a little bit before it makes another attempt through 100,000 kind of makes a lot of sense. Apple, I mean, so it's all the same. You get overbought when that trend line of the relative strength gets above 70. It's very overbought, and as soon as it closes below there, it's for me it's a good sell trigger. But generally it oscillates between 40 and 30, so 40 and 70. So you could whenever, in the case of Apple, it never really gets below really 40. So these are all just because it doesn't get oversold, you never get down here below 30 in Apple. That's basically just telling you that you're not going to get oversold, right? Anytime once you put in a pattern where if it gets down to 40, it's as low as it's going to go. That's probably a place you want to buy it. Relative to any of these it's a tool. It's not a science. It's an art. NVIDIA is another good one. We got higher highs still in NVIDIA, but relative strength is falling like a rock throughout the year. I mean, NVIDIA put in a lot of gains this year. It's starting to potentially peak out now. Is it going to roll over? I don't know. but the divergence between price and relative strength is definitely something to watch right now for NVIDIA. All right, TSP fund charts. So we closed the month on Friday, and so this is the monthly candle for the S&P 500. I went back to this is the bottom in 2009. Trend lines are, you're trying to get the average trend, right? COVID was a bit of an outlier. It broke through, down through that trend line, and then immediately reversed and kept on going. So the trend is definitely in place, right? We have so at some point, price is going to get back down to that trend line. Who knows? We can keep going higher from here. But at some point, price is going to come down and revert to that mean, that trend line. This was a 25% drop about. We aren't quite as high above the trend line as we were back at the top in the beginning of 2022. But if we did come down this year, that would be something like a 25-30% decline right there. Not to say that that's what would happen, but at some point, and until it's a monthly chart again, right? So that blue line is the 5-month moving average line. That's a really good first indicator, because most of the time, once the market gets, we have put in some kind of big correction, once it gets above there, it finds support at that 5-month moving average line, right? For most of the time, it's finding support there. When it breaks it, it's a big deal. So if you're looking at this from a monthly perspective, your bias has to be that we're in a bull market until we get a monthly candle below that 5-month moving average line. And the weekly charts, so now we're looking at the actual numbers for the TSP. So if you looked at tsp.gov, that would be the actual closing price this week for the C fund, up 1.08%. So finished the week at new all-time highs for the week, new all-time highs for the day. Relative strength, is it diverging here? Yes, but it's not horrible. Can definitely continue to go higher, no doubt about it. This is the 20-week moving average line. So on a weekly basis, until we get a break below that 20-week moving average line, the market just keeps moving higher. It can oscillate, right? But it generally will keep moving higher as long as we stay above that blue line. S-Fund. S-Fund's breaking out. Like, there's no other way to look at this chart. This was the prior high in 2021 at about 90. We blew through that 90 level election week, had a little bit of a pullback the following week, and just kept on going. That's an explosive move to the upside on small caps. They're more volatile than the C fund, but there's no doubt there's a breakout in the S fund. I fund. If you're a subscriber, definitely you want to look at the newsletter this weekend. It's mostly about the I fund and the F fund. The I fund here has pulled back a lot, right? While the S fund was going straight up, C fund also going up, right? The I fund has been going down since September. And it's going down because the dollar has been going up. And so that's what we're talking about this weekend in the newsletter, is the relationship between the dollar and the I fund and the 10-year yield and the F fund. But right now, we had a sell trigger on a weekly basis back here when we got below that 20-week moving average line and RSI got below 50, right? But it looks like it's trying to put in a bottom here. So we shall see what happens with the I fund. And then the F fund, we're back onto a buy trigger as of this week. We got back above that 20-week moving average line. RSI had found support there at 50 and popped up this week. So the F fund is back on a buy trigger. And if you saw the market this week slide that I put out on Saturday morning, the F fund was up 1.47%. It was up the most this week. So doesn't mean you necessarily want to be in it, because as long as the stock funds are going up, they tend to go up faster than the F fund does. But if the stock funds start to roll over, the F fund, having just broken out here, is very likely to be going higher as the stock funds are moving lower, if that's what happens. And the G fund just keeps on going up and to the right. It just doesn't do it very quickly. So you get 0.1% move to the upside this week. Alrighty.
Questions. As usual, if you have questions, you can put them in the comment section wherever you find the video. If there's no comment section, you shoot us an email, support@growmytsp.com. The support team will get it on over to us. Hope everybody had a good Thanksgiving. If you weren't able to be with family and friends, hope you still had a good time.
Yep.
And looking forward to the holiday season. Let's see if Santa Claus shows up.
Yeah, Santa Claus rally. I don't know if that'll be next weekend or the week after, but we'll get to that for sure.
We'll be talking about it. All right, guys. We'll see you later.
Have a good one.